Good morning and welcome to PACT's Navigating the latest round of the PPP and COVID-19 relief funding. I'm Dean Miller, the President and CEO of PACT, and we're excited to be joined by a number of experts in their fields that have been advising companies and clients for the past several weeks on a number of different programs. We're going to focus primarily on the PPP, but also hear about a state program toward the end of this webinar. I want to thank Baker Tilly, Pepper Hamilton, Fulton Bank, as well as Pepper Hamilton's new partner, Troutman Sanders. They'll be merging here shortly. Let's jump in and provide a little bit of background on what we're doing. We're going to start off with Michael Donato of Fulton Bank talking about Paycheck Protection Program and specifically the loan forgiveness aspect of that. Then we'll be joined by Christopher Rossi of Pepper Hamilton and James Stevens of Troutman Sanders, as well as Todd Bernhardt of Baker Tilly for a panel discussion. They'll have some time to focus on a few questions that they have been hearing typically from their clients, again, around loan forgiveness, around affiliation rules, etc. And there'll be opportunities, obviously, for them to field questions from the audience. More on that in a minute. For the last 20 minutes, we're going to hear from Steve Diattore, the Deputy Secretary of Technology and Innovation from the Pennsylvania Department of Community and Economic Development. Steve will be specifically talking about a new program launched at the end of last week with the Ben Franklin Technology Development Authority, with a couple of components that can be accessed by startups in Pennsylvania. Any questions that we don't answer during this webinar, we will certainly follow up. Let me review etiquette. All attendees are muted. There's quite a number of you on the phone. Please use the Q&A window to ask any panelist questions. Of course, you can also use the chat function just for general communication with other attendees on the webinar, but specifically for questions, use the Q&A window. Hosts and panelists will be monitoring questions throughout. And as I said, we'll get to those as we can and follow up if we're not able to. Let me turn the mic over to Michael Donato. Michael is the Senior Vice President and Team Leader for SBA Lending from Fulton Bank. Welcome, Michael.
Thank you. Good morning, everyone. I wanted to talk about the second round of funding for PPP. The second round is $320 billion, and it went live yesterday morning at 10:30 in the morning. In this round, the SBA and the Treasury Department wanted to try to make certain that the larger banks did not have an advantage over the smaller banks. So carved out of the $320 billion is $30 billion for banks in the $10 to $50 billion asset size, and another $30 billion for banks less than $10 billion in assets. For those of you on the call, if you haven't yet applied to PPP, I implore you to do so today. The money is not flowing out as quickly as we anticipated because the SBA is purposely putting a limit on how many applications banks can get approved in any 1 hour. So for instance, for our asset size, we're supposed to be able to have 400 applications approved per hour. Yesterday, we were only getting 60 approved. So they're doing that purposeful slowdown based on the asset size of the bank in order to ensure that the smaller banks' customers do in fact get funding in the second round. Next slide, please. Next slide, Danielle. The most important aspect that I want to focus on right now is loan forgiveness. As soon as the loan is funded, the 8-week measurement period begins. And in that 8-week measurement period, it's important for the small business concern to be able to keep very good records associated with all of their payroll. At its core, PPP is a program to keep workers on the payroll and off of the unemployment rolls. So even if a customer is not open yet, the measurement period still begins at the date they receive the loan funds. So in essence, they will have to call their workers back to work even if they can't work yet, because that 8-week measurement period begins not when the business is allowed to open, but when the loan actually funds. The way the loan is structured, if the small business concern handles all of their accounting correctly, 75% of the loan should be used for payroll and direct payroll expenses, and no greater than 25% for interest on mortgages, rent payments, or utility payments. If the business keeps to that ratio, then the expectation is the entire loan would be forgiven. If in fact the loan is not forgiven, the remaining balance of the loan would amortize over 18 months at 1% interest fixed. Forgiveness is based upon maintaining full-time equivalent. So it's based upon the number that you place on your PPP application versus the amount of employees that you actually hired back. You also can have a decrease in wages, but of no greater than 25%. Danielle, if you could go to this slide, please. It starts with Section 1106. Section 1106 is the section contained in the CARES Act that speaks exclusively to forgiveness. What I'd like to also mention is that in the eyes of the SBA, a borrower's forgiveness calculation is calculated based upon the forgiveness that is currently in force when their loan is funded. I'm saying that because getting this program standing in such a short amount of time has meant that the SBA has continued to play catch up. They have recently issued, and this sounds ridiculous, their third interim final rule. With every SBA loan program, they ultimately get to something called the program guide. As bankers, we are thinking that there may never be a program guide for the PPP program, so we are basing all of our analysis of our clients and also eventually the forgiveness calculation based upon what you're seeing on the slide in front of you. This was contained within the CARES Act, and in each of the interim final rules, again, 3 have been released thus far, it really hasn't changed substantially. So again, 8-week period for forgiveness to be calculated, and then the 4 bullet points at the bottom are the items that you should keep good records of. On the next slide, it talks about the first interim final rule, providing the absolute clarification between 75 and 25. Something to keep in mind, 75% towards payroll and no greater than 25% towards non-payroll expenses. Danielle, next slide, please. So here's how forgiveness will work at the end of the 8-week period. And again, most banks are trying as quickly as possible to get their arms wrapped around this. There is a requirement that we close these loans within 10 days of receiving the SBA's loan number. So right now, every bank is focused on closing loans as quickly as possible. As soon as that timing is done, we will most likely switch those triage teams to become teams that will take the forgiveness aspect of it and review all the information. So after the end of the 8-week time, you would present your package to your bank. Again, the most comprehensive package will put you in the best position. And payroll, if you have a payroll reporting company, they would probably be in the best position to get everything. The bank then has 60 days to review and sign off on the package. It should be noted that the bank is assumed to be held harmless in this process. It is the borrower's certification from what they sign on the PPP application, stating that everything they present, either in the application or to the bank to represent forgiveness, is accurate and correct. The bank does not have the onus to prove what the borrower is giving to them, simply to review what is presented to them and sign off on it so that we can hopefully be able to forgive 100% of the loan. Next slide, Danielle, please. Okay. This slide simply talks about the 60-day window for the bank. And it does talk about, because there will be some instances where the customer may not have their entire loan forgiven. And if that is the case, the structure of a PPP loan is the first 6 months are on full deferment, although interest does accrue. If in fact the entire loan is forgiven by the bank, and of course the SBA, then the interest is also forgiven. If the entire loan is not forgiven, the accrued interest is added to whatever is not forgiven, and then after the 6-month interest-only period, there is an 18-month amortization at 1% fixed. Thank you.